Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today in our call, we have Shahbazi, the CEO of WELL Health Technologies. WELL Health trades on the TSX under the symbol WELL and in the US under WLYYF. The company is trading at $7.50 with roughly 164 million shares outstanding, or about a $1.23 billion market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trevor. I'm excited to have I'd like to call him an old friend. I haven't seen him in a long time, but Shahbazi, CEO of WELL Health, somebody I've known for a number of years now and watched his meteoric rise to prominence in the Canadian capital markets. CEO of one of the best performing stocks on the TSX Venture in 2020. WELL Health returned about 350% over the last 12 months. So obviously, this, along with a few other things he's done in the past, is rightfully made him a star, at least in my mind. Happy to have you here, Hamid, and happy to know that you're going to give us a presentation here.
Thank you so much for having me, Paul. Really appreciate it, and always love being involved in your forums and following your movements as well. Thanks for being such a champion of small cap out there for all us entrepreneurs. Yeah, I'm delighted to have an opportunity to provide an update on WELL. I'm assuming some of you I've met before and presented to before, given that I've been at these forums, and I'm sure some of you are returning. But even if you're absolutely new to WELL, I'll make sure that that I provide sufficient background. I'm just going to share my screen here quickly, and then we will get started. Okay, here we are. So let's get to. So I'm going to actually start with a couple different things. WELL is as Paul indicated, is a company that has really grown quite considerably over the last little while. In fact, PwC, our auditors, told us last year we may have been the most active acquirer on the TSX of any company. And one of the reasons why we are acquiring so much is because we are a tech-enabled healthcare company, and in Canada, we have rampant fragmentation in our healthcare system, whether that's in terms of our clinical population, in terms of systems. We still fax each other at scale. So when I started the company, I immediately wanted it to be a public company because I knew that that part of the problem in Canada, at least, and elsewhere in the world, but certainly one of the things holding back digitization and modernization of healthcare was this fragmentation and this lack of cohesion. So a big part of what we do is to be a decentralized capital allocator in digital health. And so we somewhat aspirationally refer to ourselves as the Berkshire Hathaway of tech-enabled healthcare. And to sort of break that down, we are, we're trying to emulate prudent and disciplined capital allocation, but like Mr. Buffett at Berkshire Hathaway, where we buy into businesses that are already performing, management teams that are professional and P&L focused and want to be left to their own devices to continue to execute. The big difference with us is, as you look at our current business unit structure, we essentially have 6 business units today. 7th coming with the acquisition of CRH Medical, and I'll talk a little bit about that as well. Is that these are all themes in our minds that are aligned with the future of healthcare. And so our very first business unit was health clinics, and our view and aspiration was to help transform clinics into the clinic of tomorrow. And some of that was, very perfunctory, improvements, like being able to allow, patients and practitioners to use online tools to make appointments together, all the way to telehealth, all the way to workflow optimization inside the clinics themselves. So we bought a number of clinics and we just started to implement these technologies. And our view was that this would, improve profitability and growth. And it's happened. I mean, we have acquired these clinics, and we've essentially, dramatically improved the profitability of them. And our wages as a percentage of revenues has gone down dramatically. I mean, part of the problem that happens when you don't have enough tech and workflow and standard operating procedures is that you just throw people at the problem. And in the first 20 clinics that we bought here in BC, initially they were, a lot of them were on different EMR systems. They didn't have any real kind of workflows and standardization. And so we're really, really pleased, because a lot of people out there that are kind of positioned as capital allocators are out there buying stuff and typically don't report back on what actually happened after they bought these assets. And we're very pleased with the kind of performance that we're seeing post-transaction. So that's our health clinics. And then our second business unit was electronic medical records. This, for all intents and purposes, is the ERP system of a medical clinic. This is a software that runs everything from sort of soup to nuts. And we started to consolidate a kind of a cottage industry of open source EMR companies under the banner of OSCAR. OSCAR is an acronym that means Open Source Clinical Application Resource, which was an open source project started by McMaster University over 10 years ago. And just like Linux being an open source project, there was a kind of a company called Red Hat in the Linux world that started to professionalize and support commercial applications. And so we bought a bunch of these kind of like analogs to Red Hat in the EMR open source world. And so we've acquired a number of businesses, and now are the third largest provider of EMR services in Canada. And we have a global EMR business in 3 countries, with Canada, New Zealand, and Australia, and really want to get into the US. And closing in on number 2 in Canada very, very, very shortly in our minds. Number 1's TELUS. And then really we then formed our digital apps business unit, which is really the consolidation point of all our platform technologies. One of the things that's really unique about WELL is that we have platform technologies, meaning like we are a hardcore software provider. We have SaaS revenue, we have recurring revenue. We power practitioners outside of our walls, but we also power practitioners inside our walls. So we also have patient services revenue. And I think this is a really unique aspect of the business that's not shared by many other companies. It seems that for the most part, companies are generally, delivering patient services or their platform technologies. I think we get enormous leverage from doing both. And so we've got one of the largest telehealth businesses in the country, possibly the largest or the second largest, depending on what metric you use here in Canada, and a smaller but fast-growing one in the U.S. And we've acquired multiple companies in the space, so we're taking very much kind of a portfolio-based approach. We then started our cybersecurity business. Again, in our view, as more and more healthcare data comes online, it is the most valuable data in the world, and healthcare is the most breached sector in the world. And so our view is that data protection is very much an important theme in the future of healthcare. So we've now acquired 2 companies there. We have a substantial, $20 million revenue business, profitable, growing there, and it's our intention to really grow every single of these business units substantially and continue to consolidate within these sort of boxes that you see here, these units. We then formed our allied care division. This is all matters of healthcare that do not involve an allopathic or medical doctor. So it could be clinical counselors, physios, those types of folks, sleep technicians. We have 2 companies there. They're growing very quickly, great per unit economics. Again, an area with a huge TAM that we will continue to acquire in. And then we bought the largest provider of outsourced billing services to Canadian doctors in the country, a company called Doctor Care. And if you're a doctor and you'll find sometimes that the schedule of doing your billings is very complicated. It's based on different provinces and it's always evolving. And so if you want a professional company to do that work for you, Doctor Care is that company. And we're now going to be using Doctor Care's platform to consolidate a bunch of other boutique, small billing and back office businesses. The billing and back office vertical in the US alone is worth over $100 billion. It just goes to show you, these are enormous TAM businesses. CRH Medical is a company that we announced on February 8th that we are acquiring. This is a Vancouver founded business that became very strong in the US in the area of anesthesia services. They started out with a hemorrhoid banding device called the O'Regan device, and they trained 3,000 plus GI doctors, so gastroenterology doctors, or doctors of gastroenterology, and this banding device provides an interventional treatment for hemorrhoid discomfort. It's an incredible device. It has yielded outstanding results, and GIs are typically very grateful. It's really kind of a best-in-class device in its category. And what happened is they used this to develop this trusted advisor relationship with GI doctors. And GI doctors do a lot of colonoscopies. That's a sort of bread and butter business for them. And the sedation services that like to sedate yourself and get you ready for a colonoscopy. In the US, the fastest growing sedation services is propofol, which can only be provided by licensed anesthesiologists. So they're now a big provider of anesthesiology, and 95% of all those opportunities came from their O'Regan device. And so this company, just came out with its Q4 earnings. They're essentially on a $180 million revenue run rate, 25% free cash flow margins. And these were actually their analyst projections before their Q4 just came out. So they're actually were even better. They blew past their analyst projections. It's a public company, trades on the New York Stock Exchange. We announced that we're buying it for $4 US a share. Immediately pre-pandemic, this company was trading at much like higher than $4.20, $4 a share. I think as high as $4.20 or $30 or even $40. And we're really pleased to be able to buy them at $4 a share. It kind of works out to about 6.5 times EBITDA if you don't back out the non-controlling interest, because they buy a lot of businesses at 51%. They've done 32 acquisitions of their own. They have 500 targets. They're incredible capital allocators. They've been buying these anesthesia operating companies that provide services into the GI clinics and ambulatory surgical centers. And so this boosts our revenue to over $280 million on a run rate basis, if you look at kind of analyst projections of WELL over the next year, and over $50 million in free cash flow, and over $79 million and these are all CAD figures, by the way, in EBITDA. So we're extremely excited because based on how we funded this, we were only taking on about 17% dilution. And so this represents about 120+% in terms of per share accretion on revenue, and 800% plus per share accretion on EBITDA. And with our other LOIs, we have about 9 other signed LOIs. We think that we get to about $400 million in revenue and well over $100 million in EBITDA by the end of the year. So the company's really just kind of burgeoning, and we think that paves a clear path for WELL's US IPO, same way that Lightspeed did their US IPO last year. It really helped them. If you look at where Lightspeed was just over a year ago, They're about our market cap. They did a US IPO, a couple large transactions, and they're now a $10 billion company. And we very much think that we're on that same road. In fact, we'll have better numbers than Lightspeed immediately after this deal. So, and probably growing quicker and far more profitable. So we're very excited about that. A lot of people think of CRH as a clinical company. It is actually not a clinic. They don't own clinics. What they do is they provide 2 products and services to GI doctors. And what WELL wants to do is take those 2 products and services and make them 5. So we want to provide data protection. Every one of these GI doctors needs cybersecurity protection. Every single one of them needs digital patient engagement in terms of allowing their patients to book appointments with them. For some of those appointments, we estimate about a quarter of all the appointments that a GI doctor provides can be done virtually. And there's quite a bit of under digitization in this specialty area. And then last but not least, we want to provide chronic disease care management revenue opportunities for GIs to get their patients to buy into opportunities to improve their health, just like what Livongo does in terms of diabetes for their patients. Chronic disease care management is a massive business. We're talking about chronic disease is worth 20 to 30% of all healthcare costs in the US. Put that against $4 to $5 trillion in costs, and that's 20 to 30% of that is chronic disease. And a lot of chronic disease is behaviorally driven. So the problem is sometimes people just don't know how to behave. So GI doctors deal with a lot of chronic disease, lower gastro issues like Crohn's, colitis, IBS, things of that nature. So we think there's a substantial opportunity there. I've already kind of referenced all this in terms of what we're doing for GI providers and the market opportunity that we see. And I've already kind of referenced a lot of this. What's really unique about how we did this deal with such little dilution is we raised $302 million at 25% premium to our then 5-day VWAP price, pre-announcement price. To our knowledge, this had never been done in TSX history before, to raise this kind of money above market price to that degree. And Mr. Lee, was a incredible shareholder of ours, he's I think Forbes just came out with a list, and he was in the top 50 billionaires in the world. I think he was number 30 or 40 something. And he and his partner came in for 100, and then the other $202.5 million come from about 8 large institutions with a combined AUM of about $500 billion, most of which are Canadian and one of which is US based. CRH also has a $200 million line with JP Morgan, #1 healthcare bank in the United States. 125 million committed and 75 million is their accordion. So that alone shows you the quality of their revenue and EBITDA. It is not easy to get a credit line like that. The other thing we did to reduce the dilution is we used their own credit line to buy them. So we did the premium to market deal, and we got JP Morgan to agree that we would use their credit line to draw down on that because they were fairly underlevered. So that's how now all of our board and most of our management bought into that 980 offering as well. I bought $530,000. The entire board and management altogether was about $1 million. I've put over $6 million of my own money into the company. I've never taken $1 in cash, only restricted stock. So we are incredibly bought in and aligned with shareholders. We're very excited. I mean, these are analysts' expectations just once CRH closes, and tomorrow's the shareholder vote, and the vote's looking really good based on intermediary reports. So we go from roughly 50 to 210 to 300 plus, and this is not even with any other LOIs. This is just what analysts are expecting. And look what happens on the adjusted EBITDA. And frankly, we think we'll blow these numbers out of the water just based on everything else that we've got going. But look at what happened here also on the bottom line. This just goes to show you the discipline. instead, even though our revenue's been increasing, we were very intentional not to lose more money. I mean, obviously CRH is a game changer, but we were basically break even in 2020 and profitable in Q4. So that discipline's always been there. And the reason why we want to go to the US is simple. Like post CRH and some of our other deals, we'll now be in the snack bracket of quantum in terms of the revenue of the US companies, but with half the multiple. So we think this is a fantastic opportunity for those folks to know that that is an intention of ours, because you look at other tech-enabled healthcare plays in the US, and again, it's the multiples are much higher, and usually the multiples are higher in the US because the quantum's higher, and we'll also be a majority US revenue company as well. So we think we have all the makings to make that a reality. And I will. How am I doing on time there?
You can take as much time as you want. We have plenty of time. It's completely up to you.
Awesome. Well, this is just a quick table to show you all the different times Mr. Lee and his partner have invested. So you can see it started in May 2018 with 5.2. He kind of continued to, participate in some of the different offerings. He and his team. He and his partners put in 23 million and 100. So you can see they are now scaling up their involvement in the company. And it's really remarkable because they're now connecting us with their business partners. And as we become more material in their portfolio, I mean, this is obviously in reference to his wealth, it's not a big deal, but it is a sizable capital allocation for them as well. And then you see all the management investments. Where you see NA, we were not invited to invest. Anytime we were invited to invest, we invested. And so I'm really proud of that, just because I think it's very unique to see this kind of alignment in capital markets where management teams are thinking like shareholders. They're acting in the way that is conducive to the long-term improvement in shareholder value. We're a very disciplined company. That is our secret sauce. Our secret sauce as a management team is the more successful we become, the more disciplined we get. And you need that because the more people approach you and the more deals you get shown. So that's a big part of what we're doing as a company. And of course, our team is very, very strong. I mean, one of the, I think really fantastic things that we had straight out of the gate was a number of us had worked together before at TIO. So we just had enormous ability to kind of, know each other and get moving. And so Eva at TIO was my SVP of M&A, Amir was my SVP of Ops, and Chris was my Chief Revenue Officer. Our Chief Medical Officer is Dr. Michael Frankel, who ran the largest chain of clinics in BC before we bought them. Arjun Kumar was the CEO of the largest open source EMR company in the country, Kai Innovations, and we're thrilled to have brought him over. Shervin came over after Enghouse bought Dialogic, and he was at Enghouse for a while, and then came over with us. If some of you will know that Enghouse's CEO and not founder but CEO is a mentor of mine. I learned a lot of my capital allocation from Steve Sadler, and so it's great to have Shervin. He was actually working in Enghouse for a while and understood some of the things that were going on there. And Ian Patterson, fantastic background in public health for data protection specifically. And great board, Tara just joined. She ran the healthcare practice at PwC, so couldn't be more on point in terms of our business. Ken is the CEO of Alpha Cognition. I think he's actually just leaving that position, but CEO of a life sciences company, background in healthcare, and a lawyer. Always good to have a lawyer on a board. Tom is our audit committee chair. He was a big investor in QHR. Some of you will remember that story, and he's just been a well-known analyst and just all-around great guy. and John Kim is been a Bay Street portfolio manager forever, very well respected. So, great. I think a bunch of really fantastic board members that have really helped us. On my side, you see this broadband TV logo there. I'm the lead director there, and was there really from the very beginning, helped Shahrzad start the company, and very proud of where that's evolved as well. And I'm really kind of a tech enablement guy. I did TO, which was tech enablement of payments. BBTV was tech enablement of digital media, and broadband TV has the world's #1 technology platform for influencer video monetization. It's an incredible company. It's tremendously undervalued in my opinion right now. So, very proud to be affiliated there. And that's really it. I think we're very excited about a number of things. Even before COVID, we were doing quite well. We'd already hit a couple $100 million market cap, but COVID was a game changer in digital health. It caused a multi-year acceleration, not just in telehealth, but in all factors of digital health. So all these themes that we have been investing in were accelerated. EMR was accelerated, data protection was accelerated. And of course, even allied health or medical clinics, everything that we do, we're not just investing in these businesses as they are. We're investing in these businesses with the knowledge and awareness that as they become more tech enabled, they will become better businesses. And we're seeing that firsthand. So that's really about it. Back to you.
Perfect. No, thank you. Listen, I mean, you managed to be able to grow this company and accumulate a phenomenal team, generate fantastic synergies. I mean, it goes on and on and on. But why don't we talk about the beginning? Like, how did you even come up with the idea to take on this crazy, huge endeavor?
Great question. I've always been really interested in healthcare and wellness, and the predecessor to Well Health was Wellness Lifestyles. That's kind of how the company did its CPC. A lot of people think that Well went public as well. It actually went public as Wellness Lifestyles, a company that was not even focused on the medical healthcare market, what we're doing today. It was focused on strategies and solutions that would help you age gracefully. So yoga, meditation, those types of technologies, and kind of getting behind those. And at that time, I'm still working, at TO/PayPal, and as this company's being growing. And even though I started it, I hired a CEO, and really what happened was, as we were researching, how do we really get this company going? Where do we focus on? What is our strategy? We started to, the more research that we did, the more we realized that we sort of tripped over this notion that, wait a second, healthcare is not digitized. And the more research, and we couldn't really believe the degree to which it lagged. And so we did a bunch of research, and we started talking to some people, and there's some people that told us that it will never digitize, that it was just, or that never was, this is too strong a word, but it would still take so long. It would be so painful because of all the challenges associated with it, especially in Canada, given the governmental involvement. Our view was that was not true, because we would talk to other folks, and what we found, and where we were resting our hats, was patients have always wanted digital enablement. And anytime you create access and convenience for people, for consumers, for patients, they will consume it. So it was the practitioners that were really holding it back. It was that sort of old guard of doctors who weren't like super hard change management. These guys don't give you a lick of their time because it's so valuable, because it's a fee for service world. So the more I do, the more I make. I don't make passive income. And the bright light in our mind was the millennials that were coming in and becoming new doctors. And to them, it was crazy, like this generational shift in demographics within the practitioner core. Our view was, it was highly unlikely that as more and more millennial doctors came in, that they would not be just completely, like, they're digital people. They would cause this revolution to happen, and that's what we were hanging our hats on. And the other thing that we found too is that the biggest there were many roots of problems that were causing this lack of digitization, but the tap root, the main root, was again, aside from the practitioner stuff, it was extreme fragmentation. And this is where the idea was, okay, well, if our business is about creating cohesion, i.e. consolidation, that could also be helpful in its own. So this practice of acquiring clinics, acquiring technology companies, forcefully connecting the dots between them and creating more cohesion could by itself create this inflection point. One of the things that we're really proud of is that since then, since WELL's success, a lot of other capital flows are now coming into healthcare. You have so many other companies that are going public, clinic groups, and we think we had a small contribution towards that, but it's still going to take a little bit of time for us for this sector to catch up with other sectors. But I think the pandemic was incredibly consequential in terms of making that happen.
Mm-hmm. It clearly everything seems in this space to just sped up. It probably what would have taken 4 or 5 years now seems to have happened in 4 or 5 months, and everybody's adopted to telehealth and all the different things that you were sort of promising as a tech-enabled business. The other thing that clearly you attracted some amazing people around the business. I think part of that comes from your track record. Let's talk a little bit more. You started a company, and originally when I got to know you, it was around a company called TIO. You successfully sold that to PayPal, and maybe give us a little bit of your journey there, and then talk about how the sort of doors that's opened up, and ideally what I want to get to is Li Ka-shing. I mean, how do you land somebody like Li Ka-shing as a capital partner?
Yeah, great question. And so, the TIO journey was really interesting because I think a lot of the reason why WELL's doing well right now is all the mistakes I made at TIO, learning, growing, and hanging in there. I think what happened is TIO took a long time, and I got to know the capital, and it went public in '99. So think about the fact that it went public in '99, sold in 2017. So that's a long time to be a capital market CEO, not get fired, and be able to get. And you know what? A lot of people don't realize that is the opportunity you have with a public company. Sometimes people. I joke and I say, if it was a private company, it wouldn't have worked out that way. I would have been long gone. But I just really continued to, like, at the beginning, the journey was all about organic growth, and then really I started to think about inorganic growth, and the first $45-50 million of the revenue of the business was all organic. We had something like 36 straight quarters of transaction revenue growth, and it was just really about continuing to add payment systems, acquiring payments, payment volume, and putting it on the platform. And we just did that religiously, every single quarter, but no one cared. The stock wasn't going anywhere. You may have remembered that.
I do.
And then I met my mentor, Steve Sadler, and then I learned how to do M&A from him. And then I eventually did my first deal. And really, you can look at the point in time, the inflection in the stock from 2013 through 2017. We went from a $15-20 million market cap to over 300 million inside 3 to 4 years, and it was pretty incredible. So I think that the moral of the story for me is if all you want to do as a software company is grow organically, it probably doesn't make sense for you to be public. The whole idea of being public is you get that second currency, and you can do things from a business development and corporate development perspective that allow you to use, your shares as currency, and be a lot more creative in deal making. And I just really learned to love to become, a capital allocator. And a book that Dave Barr at Pender gave me, changed my life as well. The Outsiders, which talks about, it's basically 8 short stories about CEOs who who regard themselves as in their role as a CEO as essentially the master capital allocator of their business. And of course, Warren Buffett's one of those. You know, John Malone is a celebrated capital allocator. But I really, and again, also having a mentor like Steve Sadler, who's an incredible capital allocator, I just came to really love the idea of as a CEO, to be to be using to be sourcing capital in a cost-effective way, and then to be spending it in a way that creates accretion in a very replicatable way. And if you can do that in a very in a very nice sort of replicatable pattern, I think it's incredible how much value you can create in the capital market. So I think that was a big part of my journey.
Mm-hmm. And then Li Ka-shing, how do you attract somebody like Li?
Yeah. So I have to tip my hat to Broadband TV there. So I was invited to Broadband TV was invited to by the Google founders because they're the largest video partner for Google on YouTube globally, with their incredible scale. And so I tagged along with the CEO, and I was fortunate enough twice to go to this this I guess very exclusive, prestigious event within Google called Google Camp, which is basically a place where they invite only about 100 people. Most of them are very, very notable people that you hear about, everyday characters. And then they invite a small number of their own partners just to sort of like intermingle with the group. And then I met Li Ka-shing's partner there, Selena Chow. Mm-hmm. And I formed a relationship with her. And this is during the TO years. And then we just formed a relationship, and she was a spectator on TO. She didn't invest. And then really when the opportunity was to start Well, I was actually in Hong Kong on other business, and decided to just pay her a visit. And they love healthcare. I mean, it's a really big area of focus for Mr. Li, and they love technologies that are positioned or aspirational in terms of helping improve patient outcomes and things of that nature. And that's a big part of our mission. And I think because of the relationship we had created, and she instantly said yes. And within a week of that meeting, the deal was done for her to come and for them to come in and buy 19.9% of the business. Wow.
That happens all the time, doesn't it? In this world. No, phenomenal. So why don't we talk about some of the other companies? So we talked a little bit about TO. Obviously, we talked a little about Well Health, but you did mention Broadband TV. How long have you been involved there? What's your role there? And maybe give us sort of the 2-minute snapshot of what Broadband's all about.
Yeah, so I was there pretty much from day one. I was the first. I was the only it was the CEO and myself were the only 2 directors from day one until 2013 when RTL, which is owned by Bertelsmann, largest media group in Europe, bought 51% of the company. And then the company sort of meteorically grew over the last few years. And as a result of that, RTL didn't want to purchase the last 49% because it became basically too expensive for them. They could afford it, but it was just not, it wasn't, probably fantastic capital allocation for them, because they needed the capital to focus on fighting off Netflix, which is because they own most of the large broadcasters in Europe, and they're under siege by Netflix, and so really trying to move capital and basically pull together a Netflix competitor. And so the opportunity came for us to buy them out, and we did through the IPO. We had one of the top 10 IPOs in Canadian history, raised $172 million. But our IPO day, the Dow was down 1,000 points. It was the worst day of the year. It was in October. There was a lot of concerns about the election and Trump and blah, blah, blah. So we kind of stumbled out of the gate, and then we got into some tax loss season selling. And so I think the company is now just sort of finding its feet from a stock perspective. But if you look at its releases, if you look at its business updates, its business has been growing like a weed. And its platform is incredible. I think about it as like the Shopify of online digital media. I mean, it's a big platform that does a lot for online video influencers. And kind of like Shopify, where it does so many different things, there's kind of a value of one. You don't need to go to 6 different vendors. It does so much for you. BBTV also does that. It gets them paid. It has all kinds of digital tools to enhance their views performance. And basically, if you use their tools, you get like 20 to 30% enhancement on all your views, and it more than pays for, the service. But what's interesting is they don't sell the service on a SaaS basis. You have to give them all your content and give them the rights to go out and sell ads against your content. So today they sell, and when they do sell the ads, they make like 30, 40, 50% in margins. And when they don't, they make a much smaller margin, because again, they take a percentage off your top line, basically. So there's enormous leverage in this business. Once they start selling the ads in their inventory, they don't even have to grow. They could probably grow 5 or 10 or 20 times without even growing their top line, just by selling more of their own inventory. So I think this is going to be, I mean, right now, I think it's an incredible buy. It's like a $200 million market. Bruce Campbell came out and called it possibly the next Lightspeed a couple of weeks ago.
Right.
And so it's trading at like, I don't know, 6-7 times gross profit, where its comps in the US are trading at 50 times gross profit.
Wow. Okay.
40, 50 times. So I think it's a great company, and it's got some debt to its previous parent. So I think that's another reason why people are waiting to see what happens. So they have to kind of deal with that, but they still have a lot of time to do that, and they have a lot of tools, and a lot of people want to help them with that. So I think it's really interesting. The CEO's really smart. She's very hardworking, and I'm lead director and audit committee chair, and I think really the key there is to, as we improve the currency of the companies, also to do a lot of capital allocation. There's a lot of fragmentation, continues to be a lot of fragmentation in the digital media space in terms of different software companies and content providers, and being able to create a vertically integrated company with content creation capabilities and distribution capabilities, I think is quite unique.
And the symbol is BBTV. Is it on the TSX or TSX Venture Exchange?
It's a senior listed company, so bbtv.to.
Okay, perfect. And then there was another company you're a director of. Maybe mention it. It's Hire, I believe. Hire Technologies.
Yeah. A friend of mine really kind of wanted to emulate the WELL model in staffing. So staffing is another one of these industries that has been lagging in terms of digitization and modernization. If you think about, these are businesses that run the same way today than they did 20, 30, 40, 50 years ago. Anytime you encounter an industry like that, you have to think, why? Why is it still working this way? And that will change. And of course, staffing it's a business of people. It's a massive business. It's a huge TAM. And so their clinics, a la WELL, is these staffing businesses. They're buying permanent and temporary placement businesses. Temporary placement has recurring revenue. Permanent revenue, permanent placement is a bit more lumpy. But then they're also looking to buy platform technology companies so that they can, sell those through those staffing businesses to those companies. So build a substantial B2B software business through those, because these staffing businesses all have lots of business customers, and today all they sell them is people. Well, they could sell them technologies that help those people be more proficient, successful, higher performance. And so I think it's going to do really well. I think it's the stock's come off a bit lately. It's like 50-cent stock, and I think it's a $25 or $26 million market cap, and I think it's like less than 2 times sales. and you know, you're gonna, I think, see them execute on bringing in platform technologies, and I think once that starts to happen, they're gonna get a better multiple. Yesterday, 8 Capital had an analyst, that first analyst that covered the story. So if you want to learn more about the business, there's an initiation report now that you can sort of dig into.
And the symbol there is HIRE, and that's on the venture exchange, right?
Correct. Yeah.
Okay,
Higher.
perfect.
Yeah.
Perfect. Yeah. Let's jump back to WELL Health. So you've got the phenomenal platform now. You're going to continue to grow. What verticals or sectors do you think you want to beef up, or give us a bit more of a roadmap of where you really see your M&A opportunities?
So those business units that I mentioned, I think, are going to be really key moving forward. There's likely more business units coming, but again, we will only add a business unit if we feel that it if there's an entirely new category that makes a ton of sense for us to be in. But I think you're going to continue to see us, again, buying in clinics and sort of the whole medical practitioner space. And then outside of that, in the allied health space, which is our, you know, again, as I mentioned before, whether it's physio or chiropractors or kinesiologists, or all of these groups of practitioners are now being tech enabled. So I think it's a wonderful place to be. You know, again, cybersecurity will continue to get into more of these digital apps. We did launch Canada's first app marketplace for EMR integrated apps. So the idea here is that you have your EMR, which is the ERP system that runs your clinic. You can now bring in apps just like your iPhone. An app will make your phone more capable, that would do things that it couldn't do before. It will do that now for your EMR. We now have, I think, about 25 apps with 13 different partners. We want to get that to about 100 apps. You may ask, like, how could there be that many apps? Well, there's an explosion happening in digital health. I mean, in terms of devices, remote patient monitoring, there's all kinds of ways in which data is being captured clinically and needs to get back into the EMR, and then the EMR that data needs to flow from the electronic medical record system out to what we call PMRs, which are personal medical record systems. A big part of the trend in healthcare is patient-centric healthcare, which involves getting the data in an intelligent way back into the patient and nudge the patient to do things that help them get in better health. So if I asked you the question, what do you think is the biggest determinant of your health? And a lot of people say, well, maybe your socioeconomic, standing, and some people would say your zip code is a great determinant of your health. It's actually your behavior. The quality of healthcare, your access to quality of healthcare does not determine your health. It's actually the quality of your behavior. The problem is most people don't know how to behave. So a big part of the movement in healthcare, because there's a growing difference between the population and the number of physicians. So there's a growing gap there. The only way we can close that is through amplifying physicians through technology and enabling patients to take things into their own hands. So these are very clear trends that require data to flow, and that happens through these sort of apps that integrate with all your data. Like, for example, in our combined EMRs, we have well over 20 million people. Wow. So lots of opportunity to unlock the value of that data without necessarily selling it or doing anything like that.
Yeah. So clearly a big part of your business is M&A. What's the competitive landscape like? Are there still plenty of opportunities? Are you starting to bump into, because there's been a number of other companies that have sort of tried to be mini WELL Health. They've gone public, they've raised money, and they're out there sort of competing with you to some degree to buy these assets. What does that look like, and where do you see your advantage in that?
Yeah, no, it's true. We do see more and more folks out there, getting support from capital markets, and obviously it's a great trend to see digital health growing, and we do see some asset prices being higher. But what's really interesting about healthcare is it's so big, it's so vast that we haven't had a problem with sticking with our discipline, and you know, we have to say no a lot, but we have been able to find, you know, great buys. And so I think just it's just the size of the industry and how quickly it's expanding that makes me feel that we're going to continue to have access to very high quality assets within our, you know, within our discipline ranges for quite some time.
Mm-hmm.
But I do think we have to continue to practice our discipline heavily, because it's easy to get carried away and say, well, so and so company is our competitor and they're going to buy this company if we don't buy it.
Mm-hmm.
And you can whip yourself into a frenzy about that kind of stuff. But sometimes you just got to let your competitor have you know, have the higher priced assets.
Exactly. Let him overspend. let him overspend. Absolutely. I guess, I mean, you're a busy guy. You're a super busy guy, and I joked earlier that you probably don't get any sleep, but you look like you're 20 years old, so you're obviously getting the right sleep. You're getting everything done right, and you're staying healthy. But what does keep you up at night? Whether it's this business or just in general, what keeps you up at night?
I think the biggest thing for me is the stuff that you know, CEOs are by definition control freaks. All right. So it's the stuff that's not within your control. I mean, and what's in my control is things like creating a culture, well, that we're proud of, that you know, we're very big on risk management. So we have impeccable cybersecurity focus, you know, privacy, you know, touch wood, we've never had any incidents, which is hard to fathom given the size and quantum of the business. And we work extremely hard in terms of doing that. We're very big into ESG. We're going to be publishing a substantial ESG report over the next you know, few weeks and months. I think what I'm seeing in terms of like the turbulence in capital markets does worry me a little bit, because obviously no one's bigger than the market. And yeah, people will tell you, let the market just do what it wants to do, but you know, and don't worry about it. But I can't help but worry about it sometimes, because so much of my business is based on the currency that I have, right? Yep. And so to me, some of the things that worry me right now are just the growing influence of electronic trading and programmatic trading and AI quant trading in markets. I think it's reached a point where the level of volatility is going to be very, very challenging in the future, where you know, you're going to see incredible down days, incredible up days, you know, whiplash all over the place. And then I think just I do think that there should be some reform around shorting. I do believe that it's too easy to manipulate stocks. And you know, you see it, you know, like a lot of great companies affected very negatively by predatory investors who put out short reports. You know, they just make up stuff and then they trade against it. That kind of stuff scares me. And you know, I would be supportive of any kind of legislation that, and I know there's the Securities Commission is considering you know, requiring some disclosures for people who short. So I don't know. I would be very much in support of that kind of stuff, because I think people would be shocked to understand how much manipulation is going on at the hands of these hedge funds. It's unbelievable.
Absolutely agree. You used the word volatility a couple of times. I keep bringing that up more and more lately. The volatility is something that, especially when you're dealing with a stock-based currency, it's hard to plan around volatility and dramatic price shifts, for sure. So as investors, watching what you've done over the last little while, what metrics should we be watching to say, okay, Hamid is continuing to execute on the business, apart from just, you know, revenues and profits, or anything else that we should be watching closely?
You know, I think the very essence of our business is two things. One is making sure that, you know, when you look at the deals that we do, that they continue to make sense. And any business like ours that the company is maintaining its discipline. I think that's really, really important, because as soon as you start to see a company that is paying too much for assets that they had a discipline on before, and when you see that, I think it doesn't bode well for the future. So I think that's important. I think the other thing is continue to demonstrate leverage on the bottom line. Like grow, but if you're not getting profitability enhancements, I think that's a red flag. I mean, obviously you need some time to establish the business and get it to a mature phase, but I think in my opinion, companies are taking too long to become profitable. So personally, I like companies that again, maybe aren't there yet, but they know exactly when they're going to be there, and they have a real plan. And to me, that's extremely important. I actually think also every operator should know the 2 or 3 KPIs that really drive their business, and should be able to tell the story in a very, very efficient way. And when operators can't do that, when they can't tell the story of the business in a very efficient way and give you the 2 or 3 key performance indicators of the company, I think that's a bit of a red flag. To me, like, I watch the total number of patient visits that we deliver either through our platform technologies or through our own patient services group, and so we are quite active in terms of playing, of talking about our KPIs with the market. And I think it helps. I think people like that. We just published that we were nearing 500,000 total patient visits for a quarter. So we're now in the millions, per year on a run rate basis. That's pretty exciting for us. I think that starts to show you the quantum of the business and how all this is coming together. Last but not least, I think just organic growth. Especially as an M&A driven company, you really want to ask people in these businesses, like, at the end of the day, it's great that you're buying assets, but are they melting ice cubes or not? And that's what was really remarkable about Constellation. I mean, they bought these hundreds and hundreds, maybe thousands of companies by now, but they still see organic growth. Now, it's not much, but imagine all these years, all those companies, and what's the magic to that? It means they don't buy shit. Sorry for my French. But they buy very, very sticky revenue companies. Right. That, like middleware that's stuck between systems that's never going to come out in a minute. That's the kind of.
They're disciplined, right? They're just extreme discipline. That's the word that keeps coming up when I see that sort of success. Yeah.
You got it. Got it. That's the key.
Yeah. So where do you see this business in 5 to 10 years? I mean, it's almost impossible to plan a year ahead, it feels nowadays, but where do you want to see WELL 5 years from now?
I honestly think WELL could be an iconic Canadian founded and based company that operates at large scale internationally, globally. I think in 5 years plus, it could be a more than $50 billion company, serving in many different countries, and being quite important on the international scale. I mean, I think we're in a market that's rapidly expanding. That's, again, one of the largest sectors and important sectors in the world, and in any of those 40 countries that have modern medical systems, it's likely the largest sector, and there's transformational change occurring. So I think you're going to see us looking to really drive our currency up and continuing to use that currency aggressively to do very, very meaningful deals and good deals that, again, continue to allow us to cross-pollinate between our business units. I mean, a lot of people don't realize companies like Google have bought hundreds of companies. You think Google, you think this is a great organic growth story. Yes and no. Right. They bought YouTube, they bought Android, they bought so many companies, and you don't really you can't really fathom what Google would be without having acquired all those companies. So, sometimes to really activate people, I tell them we want to be like Google. And we have, I think, enormous value creation opportunity by virtue of continuing to allocate capital in a really meaningful way. And I think our decentralized structure allows us to have, great operators that are focused to integrate and manage those assets, as opposed to, one management team trying to do all of that. So yeah, I think it could be a really meaningful business, and that's what excites me. I mean, I'm not building this business to sell it. That's for sure.
Mm-hmm. And unfortunately, we've run out of time. I could talk to you for another couple hours here easily. But if I've missed anything, or if you think there's a key takeaway or a message you think our listeners should hear, even sort of just a takeaway, what do you want to leave the investors with?
I think I'd like to thank investors. I mean, we've had a lot of support, and I'm grateful for that. And I think one of the big things that I learned is that having a good relationship with the capital markets is key. We have 10 analysts that covered us within, basically 2 years of starting the company, 2.5 years, and that's just been really a gift. And I think also look for companies where people are happy to be public. You talk to some CEOs and they're just like so down on being public and not happy with the way things work. And we think this is a really good ecosystem, and we think that most people in the ecosystem want us to succeed. Despite the things that I said about hedge funds, yes, there's some predatory people, but I think for the most part, there's enormous support, and if you get out there and spend the time, and I during TO I had the opportunity to meet literally hundreds and hundreds of people, so I probably met some of you, and appreciate you very much.
Awesome. Hamid, just fantastic to talk to you today. You've clearly done wonderful things with WELL in the short period of time. The journey is ongoing. I'm sure we can expect further and greater things from you. I want to just thank you again. It's been a pleasure talking to you. Certainly a pleasure to know you for a number of years, and looking forward to more success and hopefully catching up with you at a later date.
Thank you, Paul. Really appreciate the opportunity again. Thanks for inviting me. It's always nice to talk to you.
I appreciate it so much. And if anybody wants more information, maybe give us your website address.
Yeah, it's just www.well.company. So not .com, .company. It was cheaper. And so I think we bought it for like $10. And I'm just like Hamid@well.company. If you want to.
It's a sign of how well of a capital allocator you are that you paid $10 for your domain. I think that's awesome. That's
right?
Awesome.
And it's easy to remember.
Exactly. Hamid, thank you so much. Thanks for joining us
as well. Take care, guys.
Okay.
Have a great day.
Bye now.
Bye.